I'm Mike April, and this is April Tax Tips. Did you realize that the wrong choice in how you pay yourself may be causing you to pay extra tax? Would you rather pay tax at 9% or 24%? It's kind of a no-brainer, right? So let's take a look at this. If you need to earn a salary, there's a couple reasons. In fact, there's 3 reasons that I see why a salary would be beneficial. First thing is, if you need to have earned income. So for example, if you have children that are in daycare, you must show that you have earned income in order to make that, to be able to offset it with the daycare expenses. The second thing is, do you need to create RSP room? So if you have certain RSP goals and you need to create contribution room each year, it's also based on earned income. So that might be another reason why a salary would be beneficial to you. And the last one is, if you've been paying into CPP or the Canada Pension Plan and you want to keep up the contributions so that it will increase your monthly CPP allowance when you retire. Then if that CPP room is important, then you would have to have that earned income and pay the CPP on that. And if you do take a salary, note that there are tax which need to be deducted and in your source deductions, as well as being a business owner, CPP would also be deducted. And employment insurance, because you're the owner, it's not like you can fire yourself, so you would be exempt from that. Unless, of course, you're looking for maternity or paternity benefits, there is an exception to that rule. But for the most part, you're just looking at tax and CPP. And you need to note, too, that there's an employee portion that needs to be paid from the salary expense, as well as the employer portion. So it's not just $100, it's $100 plus the tax and the CPP, which needs to be rolled into that in the source deductions, which have to be remitted to the government. Salary can then get expensed in your books, and the T4 slip will be created at the end of the year. So you're taxed then using your T4 at the personal tax rates, which could be anywhere from 11% up to 26%, depending on how high that income takes you to. And sometimes if you're getting money from a business while you're also from a corporation, while you're also working as an employee during the day, that money would, that salary, additional salary would get tagged on to whatever tax rate you're currently sitting at. So it can actually push you into a higher tax bracket as well. The other way is a dividend. If you pay yourself by a dividend, then it gets declared on a T5 slip. So what happens is your profits are taxed in the corporation at about 9%, and it allows you to take out whatever's remaining after the tax is being paid. It's called retained earnings, and you're allowed to pull that out as a dividend to yourself. And the advantage of that on the personal tax side is that you're now given a dividend tax credit. And to tell you how powerful that is if you were to pull out almost $30,000, you would have dividend tax credit, which would make your personal tax rate payable at 0. That's pretty substantial. Could you imagine getting $30,000 and not having to pay a cent of tax on it? Because it was already taxed in the corporation, right? So that's a major advantage there. So draws, as we wrap up, draws are the movement of money to your person. So don't overthink how you pay yourself. I usually say put yourself on a budget. If your budget is, let's say your budget's $5,000 a month for your personal living expenses, that's what seems okay for you. Just take that $5,000 a month, book it in as a draw, and then at the end of the year, then we can look at the dividend as a total. So that would be $60,000 in dividends that you would then have to have a T5 slip prepared for, so as you can put that into your personal taxes. less the dividend tax credit. So your taxes and your tax rate wouldn't be as harsh as if it was all T4 salary income. All in all, it seems like the dividend seems to be the best route to declare money on your personal taxes. However, in some cases, we also see that a combination of salary and dividend can make logical sense. So if we use the daycare example for a reference, what that means is that you could actually, maybe take $12,000 in salary so that you can actually be able to deduct the daycare expenses and get some credit back for, your monthly cost of daycare could be $1,000 a month in some cases, sometimes even higher. So that would be $12,000 that you'd want to be able to at least get some benefit back on when you do your taxes. And then just top it up in the case, where I said 60,000 might be what you want to live on. Then you would just take the difference of 48,000 and take that out as a dividend. So that's, sometimes what we see with some clients. Anyhow, that's it for this one, episode